Welcome back, everyone, to Lunch Money Investing. Now, a little known trade worth trillions of dollars may be starting to crack. And if it accelerates, it could impact everything from Nvidia and Bitcoin to the S&P 500 itself. Most investors have never heard of the yen carry trade. But a historic decision by Japan's central bank this week may have just fired the opening shot in what could be the next major liquidity battle for global markets. Today, I'll show you exactly what happened, why it matters, and most importantly, what I'm doing inside my own portfolio because of this. First, let's start off with the numbers. The Lunch Money Investing portfolio finished the week at $2,419, up roughly 1%. For comparison, the S&P 500 was up 1.04%, while the Nasdaq 100 surged 2.51%. Looking under the hood, the strongest performers in my portfolio were my momentum funds, which gained 4.2% for the week. NTUM and SPMO continued to outperform, even beating UPRO, the 3x leverage ETF. That's a reminder, investors don't necessarily need leverage to outperform the market. Sometimes simply owning the strongest trends can be enough. The weakest areas of my portfolio this week were in real estate. My custom REIT allocation fell 2.21%, slightly underperforming B&Q, which dropped 2.1%. And that weakness is actually what led me down the rabbit hole for this week's video. Because REITs are one of the most interest rate sensitive asset classes in the world. And this week, they got squeezed by two central bank developments happening on opposite sides of the Pacific Ocean. The first came from the Bank of Japan. On Monday, the Bank of Japan raised interest rates to 1%. Now, for most countries, that wouldn't sound particularly exciting, but for the Bank of Japan, it's enormous. This is the highest policy rate Japan has seen in more than 3 decades. For years, global investors have been able to borrow Japanese yen at extremely low interest rates. In many cases, institutional investors were borrowing money in Japan for next to nothing. They would then convert those yen into dollars and invest the money into high return assets around the world in a very globally diversified portfolio, which included stocks, corporate bonds, commercial real estate, private equity, venture capital, and of course, our favorite, AI infrastructure. Really, anything that offered a higher rate of return than the cost of borrowing that yen. This strategy became known as the yen carry trade, and the trade was incredibly simple. Borrow super cheap yen, convert that yen into dollars, buy assets globally, sit back and collect the spread. And for years, this trade worked beautifully, but now the economics of the trade are changing. Let me show you what that looks like. So in the past, you can borrow yen at 0.25%. Convert that yen into dollars, buy higher yielding assets. Think corporate debt, high yielding dividend stocks, whatever. Sit back, earn the difference. But now replace that 0.25% borrowing cost with 1%. And suddenly the trade becomes much less attractive. And when a trade becomes less attractive, investors begin reducing exposure. So what does that mean? That means selling assets, paying back the loans, and reducing leverage. And this results in liquidity exiting the system. Now, to be clear, I'm not saying we are currently witnessing a full-scale unwind of the yen carry trade, but the incentives that fueled the trade for years are clearly becoming less favorable every day. And that's important because liquidity has been one of the biggest drivers of this bull market. The second piece of the puzzle is the currency. If you look at the USD yen exchange rate, the story becomes even more interesting. For years, the Bank of Japan fought aggressively to defend the yen. The reason is simple. Japan imports almost all of its energy. A weaker currency makes those imports more expensive, and that creates inflation pressures inside of Japan. Yet despite intervention efforts, the yen continues to struggle. The exchange rate currently sits around 161 yen per US dollar. This is in large part because of the interest rate gap that exists between the United States and Japan, and that gap remains massive. And that brings us directly to the Federal Reserve. This week, the Fed signaled that interest rates may remain elevated for longer than many investors expected. Inflation remains stubbornly high, and the Fed knows it, and more importantly, the bond market knows it. Here's why that matters. If Japan raises rates, but America keeps rates elevated too, the yield advantage still favors the dollar. That keeps continued pressure on the yen, and this may encourage Japan to tighten further. This then puts additional pressure on the carry trade. This, of course, reduces liquidity, which puts pressure on risk assets, and that creates a potential negative feedback. And that's the negative feedback loop that I'm watching, not because it's guaranteed to happen, but because the probability of this is rising every single day. And probabilities are what we get paid to manage as investors. So, what am I doing about this? Obviously, nothing dramatic. No panic selling, no liquidation on my end. Don't worry about that. No predictions that the market is going to crash anytime soon. Instead, I'm sticking to my framework established at the beginning of this portfolio. My equity allocation remains capped at 36%. I continue to maintain a combined 30% allocation between gold and Bitcoin. In fact, I've increased my Bitcoin target allocation from 15 to 16%. If inflation remains sticky and liquidity tightens, alternatives could act as a hedge. And if I'm wrong, great. The rest of my portfolio still benefits from a strong economy and rising markets. That's the beauty of diversification. I don't need to know exactly what happens next. I just need a portfolio capable of surviving a range of outcomes. And here's the part that many investors miss. If this liquidity story accelerates and markets do experience a major correction, that's not necessarily bad news for long-term investors. A 30, 40, or even 50% decline in quality assets would simply allow us to buy more at lower prices. The goal is not to predict the future. The goal is to be financially prepared for whatever future arrives. That's exactly how we're going to continue building this portfolio towards the $1 million milestone, investing our lunch money one day at a time. Now, if you enjoyed this week's portfolio deep dive, smash the like button and, of course, subscribe and follow us for the rest of this journey. And let me know in the comments, do you think the yen carry trade becomes the next major market story, or is Wall Street worrying about nothing? Am I worrying about nothing? Anyways, I'll see you in next week's update. And, of course, protect that lunch money. See ya.